The $500 trillion banking cartel, no one talks about it. What if I told you that the real global economy, the one that decides whether you can buy a home, feed your family, or retire, doesn't exist in dollars, gold, or even digital crypto? What if the real economy is buried in contracts? Complex, invisible promises worth over $500 trillion, controlled by fewer than a dozen financial institutions. This isn't a movie plot. This is the derivatives market, the shadow banking system that makes and breaks entire nations. All while staying completely off your radar. We've been told that markets are free, that competition creates balance, and that banks just move money. But what if money itself is no longer real? What if it's been replaced by leverage? A phantom system so huge that if it fell apart, every stock, pension, and government on Earth would vanish in days. Behind the scenes, the same names appear over and over again. JPMorgan, Goldman Sachs, Deutsche Bank, Citigroup, HSBC. They are not competitors. They are co-conspirators, nodes in a cartel that manipulates value, debt, and entire currencies. The Great Recession of 2008 was not the end of the story. It was just a preview. The real system didn't collapse. It simply went underground. To understand how a handful of banks came to control $500 quadrillion, we have to go back to 1971. That was the year President Richard Nixon ended the gold standard. Before that, paper money represented something tangible, an ounce of gold in a vault somewhere. After 1971, the dollar became something else entirely, a promise backed only by confidence. When the dollar stopped being money and became belief, Wall Street saw opportunity. The 1980s brought deregulation and the birth of financial innovation. Instruments like futures, options, and swaps spread like wildfire. They were advertised as risk management tools, but in reality, they were casinos in suits. By 1998, derivatives had ballooned to over $100 trillion, 5 times the size of the global economy. And still, no one regulated them. Alan Greenspan, then the Federal Reserve Chairman, famously said, "The market can regulate itself." In 1999, the Glass-Steagall Act, which separated commercial and investment banks, was repealed. Suddenly, the same institutions that held your checking account could bet your savings on billion-dollar swaps, and they did. Banks like Citigroup and Goldman Sachs weren't just trading. They were creating entire shadow economies, selling insurance on debts that didn't exist, repackaging loans, and reselling them to one another in endless circles. By 2007, the notional value of global derivatives exceeded $600 trillion, 10 times the world's GDP. Then came the crash. Lehman Brothers collapsed. AIG needed a $182 billion bailout. But instead of dismantling the system, governments doubled down. They bailed out the very players who built the time bomb and made it even bigger. Fast forward to today. JP Morgan alone holds over $55 trillion in derivatives exposure. Goldman Sachs, over $40 trillion. The combined exposure of the top 10 US banks exceeds $240 trillion, more than 10 times the US economy. And yet, you rarely hear a word about it in mainstream news. Every time there's a liquidity crisis, a flash crash, or a credit event, the same institutions emerge richer, stronger, and more protected. We were told that 2008 was about irresponsible mortgages. It wasn't. It was the collapse of trust in a synthetic financial ecosystem that only works when everyone believes the other side can pay. The truth is, they can't. This $500 trillion web still operates today, hidden behind clearinghouses, offshore accounts, and central bank guarantees. And the most dangerous part, The public doesn't even know what the word derivative really means. After the 2008 collapse, regulators promised reform. They told us transparency would protect the system. But transparency is a myth. The derivatives web isn't monitored by governments. It's monitored by a private organization called the Bank for International Settlements. The BIS, founded in 1930 to manage German reparations after World War I. It evolved into something far more powerful, a central bank for central banks. The BIS has diplomatic immunity. It can't be audited. It answers to no nation. From its headquarters in Basel, Switzerland, it oversees global liquidity, coordinates currency swaps, and tracks the unregulated derivatives exposure of every major institution. It is the spider at the center of the web. The same web that holds your retirement, your mortgage, your government's debt, and the future of every developing economy hostage. When you hear that the system is stable, what you're really hearing is that the cartel hasn't blinked yet. In March 2020, during the COVID market crash, the Federal Reserve secretly injected $9 trillion in liquidity through overnight repos. Most of that money flowed directly to the same institutions controlling the derivatives web. You didn't vote for it. You didn't approve it. But you paid for it. The real question isn't whether the next crash will happen, it's who's already preparing to profit when it does. And the same names behind this $500 trillion system trace back to one family network. You won't believe the name. The receipts are wilder than you think. A derivative is just a contract. It derives its value from something else. Oil prices, interest rates, even weather patterns. Sounds harmless, right? Now, imagine creating a contract not on 1 barrel of oil, but on 1 billion barrels that don't exist yet. Then imagine selling that contract to another bank, who sells it again, layering bet upon bet upon bet. That's the derivatives market. No physical asset, just mathematical promises. At first, derivatives served a real purpose. Farmers hedged crops, airlines hedged fuel, but Wall Street saw something bigger: infinite leverage. By the 1990s, a new form appeared, the credit default swap. It allowed banks to insure loans without actually owning them. You could bet on whether a company would go bankrupt. It was legalized gambling. By 2007, credit default swaps alone totaled over $62 trillion, roughly the size of the global economy. Each derivative required collateral, money pledged to guarantee the bet. Yet banks didn't use their own money. They used yours, your deposits, your retirement funds, your government bonds. When a bank hedges, it's often gambling with borrowed capital. And if the bet fails, the losses are socialized. Taxpayers foot the bill. That's how AIG imploded. It sold trillions in insurance without enough collateral to pay. When the market crashed, the government stepped in with a $182 billion bailout, claiming it was too interconnected to fail. Translation: too many rich people would lose too much money. Behind AIG were Goldman Sachs, JP Morgan, and Citigroup, all tied together through opaque contracts called interest rate swaps. Interest rate swaps now represent over $400 trillion of the derivatives market. They are bets on how interest rates move. When the Federal Reserve raises rates, it doesn't just affect mortgages or credit cards. It shakes the foundation of every interest rate swap in existence. That's $400 trillion of exposure to rate volatility. Even a 0.5% shift can trigger $2 trillion in margin calls. The same 5 US banks hold over 95% of all derivatives exposure. They use offshore subsidiaries and clearinghouses like the London Clearing House and Eurex to mask ownership. Meanwhile, the BIS coordinates collateral optimization, a polite phrase for letting banks reuse the same assets multiple times as backing for different trades. That's not stability. That's illusion. Imagine you and I both think we own the same bar of gold because a spreadsheet says so. When one of us tries to withdraw it, the illusion collapses. That's the derivatives market. The $500 trillion figure isn't fantasy. It's a patchwork of bets, obligations, and synthetic assets so entangled that even regulators admit they don't know where the real risks lie. In 2019, the Office of Financial Research quietly released a report calling the derivatives market a potential amplifier of global contagion. In plain English, one failure can trigger dozens. We saw that in 2021, when Archegos Capital collapsed. It used swaps to hide leverage with multiple banks. When its bets failed, Credit Suisse alone lost over $5 billion. The system survived, barely. Why? Because central banks are now part of the cartel. The Federal Reserve, the European Central Bank, and the BIS coordinate liquidity through currency swap lines, printing money behind closed doors to prevent margin calls. The illusion of stability continues, but the core is rotten. The $500 trillion web isn't about profit anymore. It's about control. Control of liquidity, interest rates, and entire governments that depend on rolling over their debt. The so-called free market is a puppet show. Every movement, every rate cut, every headline about recovery or stability is orchestrated to maintain the illusion that the system is under control, when in reality, it's one chain reaction away from implosion. If this web unwinds, the result won't be a recession. It will be financial annihilation. Because, unlike 2008, there's no clean bailout path left. Every government, every pension fund, and every insurance company is now part of the exposure. The tools created to reduce risk have become the greatest source of it. The derivatives market is now so large and so intertwined that no one can unwind it safely. Central banks are trapped in a permanent state of stimulus, not to help citizens, but to keep the cartel's bets from detonating. That's why quantitative easing never truly ended. That's why inflation became global. That's why major nations can't afford to raise rates too far. The system is built on borrowed time. History tells us what happens when empires borrow too much. The Roman denarius, the French assignat, the British pound all rose, fell, and left ruin behind. The $500 trillion derivatives empire is no different. Its fall won't look like a stock crash. It'll look like silence. ATMs not working, markets paused, banks under maintenance. The illusion freezing in real time. But truth spreads faster than manipulation when people start asking questions. If you understand this system, you're already ahead of most of the world. So the next time someone says the market recovered, ask which one. Because the one that matters, the real one, was sold decades ago. We are tenants in a house built on leverage, praying the wind doesn't blow too hard. Are we wiser now, or just walking the same path in better suits? Share this video, wake someone up, and remember, money was never real.